Hello and welcome to the second major part of this short introduction to financial statements for beginners. In the very first video, we did a quick overview of what the four major financial statements were: the balance sheet, income statement, cash flow statement, and changes in shareholders' equity. In the second video, we took a look at the balance sheet, and at the beginning of that video is a how-to on where to find financial statements. So if you're looking uh, for a place to learn where to find this information, check out that balance sheet video, which I should probably take out as its own little segment and post separately. But let's dig into the income statement. Like the balance sheet, you're going to have the company name up here. You're going to have the title of the statement, in this case, consolidated statements of income. Could say income statement, and then it lists that the numbers in the table are thousands except the per share amounts. Now, unlike the balance sheet, which is a snapshot in time, the income statement shows, again, on a very high level, how much revenue, how much expense, and hopefully there's a profit left over a period of time. The balance sheet is a snapshot, what something looked like, freeze frame. The income statement is over a period of time. So usually, most commonly, they're in year or quarterly periods. But again, like the balance sheet, internally, a company might prepare it monthly. It might do a weekly income statement. It could even do a daily income statement. It's really up to the person preparing the financial statement that has access to the data. Now, the first line almost always is net sales, and net sales is net of any returns or allowances, things like that really should not be counted, essentially counted twice for a business. But that's why it says net sales there. And the first thing you might notice when you look at a multi-year period is the change in revenues, and that's something that you would want to investigate further as to why that is happening. Now, we won't dig into it too deeply here in this beginner's video, but an upward trend is usually good for a company, but not always. And what you really need to know is how much capital the Hershey company employed to increase its revenues from about $7.5 billion to almost $8 billion. If it took another couple $1 billion to get that small increase in sales, that would not be a good thing. It would not be a good investment on the company's behalf to gain that increase in revenue. So like the balance sheet, it only tells you, excuse me, it only tells you a bit of the information. You're only getting one view of the company, and you really need to understand it from multiple angles. So that's just sort of a short little sidebar here. But the next item on most income statements is cost of sales. This might be listed as cost of revenues, but basically it's how much did the product that the company or service that the company sold, what did that cost the company? So in Hershey's case, we can see that to make almost $8 billion in revenues, it costed $4.4 billion. Now that is things like the sugar, the cocoa, some labor would be included in that. But that's, generally speaking, for the Hershey company, that might be the inventories that are on the balance sheet, what it said it cost. And then when it sells those products, it says, okay, it cost us $4.4 billion, takes it out of inventory, sells it for 8, and then what you have left over in this case is the 3.6. Now, what's really nice about Hershey's, the way Hershey presents this here in their 10K, is they provide this other segment here. Again, same information, just in a different form. And what's nice about this is it shows the percentage change year over year, as well as the gross margin. So the gross margin is simply the percentage of net sales that gross profit represents. And so what you want to look at here is a trend in gross margin. And you want to understand, again, why that happened. Are they selling more product at a slightly lower price, which might actually be good? Is it an increase in input costs that they're not able to pass on to consumers? You really want to understand that, and the notes to the financial statements and management's commentary will tell you that, but we won't dig into that too far today. They've labeled it SM&A. It could be listed as SG&A, selling, general, and administrative. That is simply, all the rest of the costs that go into producing a company's product. So it may seem, and that's why oftentimes, you hear people say, well, geez, this company has a huge markup on this. And that may be the case, but oftentimes it's because, in the Hershey company's case, they can sell their product for more than double what it costs them. One, because they have a strong position, market position, but two is because they need to make enough profit on that initial sale to cover all their other expenses, their executive and management team's cost, the employees at headquarters, the headquarters building and rent and distribution and so forth. Those kind of things, research and development might go in there as well. So those costs, again, you would like to see them growing at a slower rate than sales. An increase in SG&A, an outsized increase to sales might not be a bad thing if it represents an investment in the company's future, because expenses, the expenses have to be expensed in one period, but might represent an investment to grow sales in the future. So you really need to understand what's in them, first of all, and usually a company will provide detail, as well as the trends and why they're changing. Move down to, in this case, and every income statement is different. We're just following Hershey's here. They have these long-lived and intangible asset impairment charges. You want to know what it is that these represent. Usually, in this specific case, they're non-cash charges, but what it means is, in Hershey's case, there was a business that it purchased that it subsequently said, we don't think is worth as much as before, so we're going to write these off. You just want to make sure that, in Hershey's case, they had these over multiple years. Is that a trend? Does that represent something that they are not doing well, that they're investing in something and then subsequently writing them off in other periods? You really want to understand that. Same thing with these business realignment costs. Then we arrive at the operating profit line. This line item tells you how much income the business made, irrespective of financing source. So if the business were 100% equity financed and we're looking at this pre-tax, how much did the core operations of the business generate? It's important to look, just like revenues and costs, at not only the dollar trends here, because they can be impacted by how much capital the business employs, but also the operating profit margin. So higher is usually better, and increasing is usually better than decreasing. Then you start to look at, okay, as we move to the bottom of the income statement, that bottom line, first we have to say, okay, if the business is financed by debt, the interest expense on that debt has to come out of operating profit first. And it comes out first because the lenders have first claim to those cash flows, of course. In Hershey's case, we can see $144 million of interest expense. Now, importantly, this does not represent any principal payments on the debt. This is simply the additional cost of those borrowed funds. So the actual repayment of the debt above and beyond the interest expense will show up on the statement of cash flows. And again, is why it's so important to look at these statements together, to find out this additional information. Then you have the other income and expense, just like the balance sheet. You want to understand what's in here. Usually there's some additional detail. It could be one-time costs. So you want to understand what's in it first of all, and then also check to see, basically, does it represent a large fraction of operating profit or revenues? Just to make sure that it's not A, too big, and B, you want to understand what this recurring number is. Then, of course, you have to pay the government. So interest expense is tax deductible. So you take that out first. And then sometimes companies will list pre-tax income and then have the provision for income taxes. Hershey has listed it this way. So Hershey has reserved $234 million for what it owes the government. They happen to list their effective tax rate here as well. Now, non-controlling interests, kind of like we discussed on the balance sheet. On the balance sheet, that was the percentage of the company or unit, but on a broad basis, the percentage of the company owned by others besides the public shareholders. And so just like the ownership interest of the business, those owners have a claim to the income, some of the income of the business. And so that's what that represents. And that's small. That's small here. It can be larger at other companies. And then we finally arrive to net income attributable to the Hershey company. And so what that is the public shareholder. So if you were to buy into this company, that's the income that would be that's the pie that's available, and then it gets split up into per share amounts, which Hershey has listed below here. So $5.46 per share. Importantly, you should note that this is a diluted number, and we won't get into it in too much detail here, but if there are shares outstanding for options or some other things, the companies usually will have a diluted number here. You might also see a basic, which does not include the options outstanding. But that's the bottom line. When the bottom line is referenced, you're either referencing the net profit of the business or the earnings per share typically. And again, we won't go into this, but you can see here, management has given a more detailed breakdown of sales, and so it might list specific items or events or acquisitions that impacted sales. So you really want to understand that by digging deeper. You dig deeper, and in Hershey's case, I know this to be a fact, but oftentimes businesses will break down their revenues by geography. You might be North America or the United States, the rest of the world. They might break them down by product category if it's a larger type of business. So there's a lot more detail, just like the balance sheet. There's a lot more detail in the footnotes to the financial statements, but it's really helpful just to keep in mind what you're really trying to assess is how much money did this business make? How did it generate its revenues? What were its costs? Are there any trends that you should be aware of? Anything that stands out that might look inconsistent with what you know about the business or inconsistent with the past financial statements of the business as presented here or elsewhere. And you really want to make sure that management is doing its job in highlighting or explaining why those things are there or are, these anomalies. And if you can't understand it, you might reach out to the company's investor relations department, other investors, but usually you should be able to understand it in a footnote after doing some research. And, if you can't understand it, it may actually be the company trying to hide something. So that can happen. It's infrequent, but it can happen. So always display a comfortable skepticism when you're looking at all financial statements. it can only help make you a better analyst. So that's it for the income statement. Please let me know if there's anything I missed, if there's anything you think I should cover in the future, any other detail you'd like to see, anything specific to the Hershey company we can dig in and take a look at. But that is the income statement. So that concludes part 2. In future videos, we're going to take a look at the statement of cash flows and the statement of owner's equity. Thanks for watching, and I hope everybody will like and should subscribe to the channel, and we'll see you next time. Bye-bye.